To kick off, I want to say that I want to just go back because we're entering December, which is kind of the crazy season for predictions and forecasts. And I want you to remember and imagine December 2019, 1 year ago. You might have your favorite, analyst or your favorite bank or your favorite fund manager that might have some opinions and might have had some forecasts. And actually, Bloomberg puts them all together for us. Bloomberg has and I'm going to put this into chat. It's a very interesting list of all the predictions, and there are hundreds of them. Every bank and fund manager had an idea about what 2020 might have brought. They predict everything from GDP, specific company growth, recession probabilities, fiscal monetary policy outcomes, trade wars, inflation, negative global bond yields. They talk about all of this stuff. And there's literally hundreds of predictions in this link I just put into the chat. How many of them do you think mentioned the probability or the possibility of a global pandemic? Zero, not a single one. So just for fun though, I want to pretend that they all saw it coming. They knew, looking back at 2019, December 2019, and they knew that a pandemic was going to come around the globe, that over 1 million people a week, as high as 6.5 million in the very beginning times, for 20 consecutive weeks would lose their jobs in the United States. And then 9 months later, there would still be 700,000 or 800,000 people a week losing their jobs after 9 months. Let's say they knew that 1/3 of small businesses were going to close, that there would be 72 million global cases and nearly 2 million global deaths by the end of the year. And they knew that the US wasn't going to be some bright, shiny place where it wasn't affecting, right? That they knew that the US would fail to really kind of manage this in an intelligent fashion. Knowing all that, how many of them do you think would have predicted the market that we see now? No way to prove this either way, obviously, but I'm going to say zero. So you're going to hear us again talk about, the impossibility of prediction. You'll get our January letter, and in our January letter, we're going to talk about how planners can actually help investors have better outcomes. And I'm going to say it simply now, it's not by forecasting. Media pretends that we can explain what happens in markets after the fact, but even that's a stretch. And predicting and forecasting, not consistently or reliably possible in any way. So 2020, if it was anything, was proof that long-term planning and the commitments to that plan that we create together works. Patiently saving enough, plan appropriate asset allocation, broad diversification and rebalancing works. These are the best tools we have in our personal financial arsenal. The biggest risk that we as investors face is being drawn away from these tools for any reason. So now we're in the middle of a new December. We got a new season of forecasting upon us. And I hope we've learned our lesson. By all means, you can watch these forecasts. There's definitely entertainment value in some of them. But if you do tune in, always listen with a sense of humor and with many grains of salt on hand. Now, with that as the introduction, I want to see if anyone else, John, Scott, Paul, if you guys have any comments, I'm happy to give you guys the floor if you want to say something before we get into some of these higher frequency items. Nope. Excellent. So, as expected right now, we're actually seeing a slowdown of the improvements. If you look year over year, almost everything, because remember, 1 year ago, we were pre-pandemic. Everything is still down compared to a year ago. Month over month, about half of the high frequency data is positive, or maybe a little bit less than half is positive, a little bit a little more than half is negative. If you look over week, there's only a few things that are positive. So we've always known that in this process of ebb and flow, there'd be both ebb and flow. In the process of recovery, it's never going to be a straight line. And what we're experiencing now, and this is some of the bigger items that we see that are reported on a regular basis, is we're seeing initial unemployment claims that are, higher than we wanted to see over the last couple of weeks. They're still way down from where they were. The last print was about 850,000 newly unemployed. That's down from 6.8 million in March of 2020. And it's slowly gone down. And from now till what we hope will be, 400,000, it's going to be a very, very, very slow improvement. So last week went negative. Week before that was positive, just a little bit. And so we actually expect continued improvement in this. Maybe a more important piece of data is the continuing claims. So continuing claims also went up a little bit last week. We don't like to see that, but it's up just at about 5.5 million over the last week, but it's down from 25 million in May, right? So it's way, way down, and the trajectory is still down, but the last print was positive. And this is what we're seeing as a slowdown. In the winter months, we're seeing more infections. We're seeing a slowdown in both the high frequency data and in some of these more important, bigger data sets. We are beginning to hear conversations about a potential double dip recession. And I think when I look at, there's a few people calling for double dip. What that would look like is that looks like that Q3 was enormously positive. Q4 would also be positive. Q1 would be a little bit negative. If you look at, and there's a lot of people that look at this, but there's a Wall Street Journal survey that surveys lots and lots and lots of different managers and economists and people out there in the market. They are calling for, the average call is for about a 2% growth in the first quarter of 2021. So even with the slowdown we have, they're still expecting the first quarter of 2021 to be positive, mildly positive, and then a big pickup towards the end of 2021. So at the end of the year, we're looking back, they're expecting, again, forecasts are worth what forecasts are worth, but they're expecting an average GDP of 4.5 or 5% next year, which would be a really positive year, one of the better years we've had in the recent past. So even though there's talk of double dip and there's potential for a weak first quarter because we are slowing down before we ramp up vaccines, it's still not the high probability outcome that many people are talking about. Finally, there's two other pieces that are really important to mention, and then I want to hear from Scott and John and Paul if they want to say something. The first is, we have seen more business starts in 2020 than we've seen in more than a decade. Some of this is, perhaps required. People that lost their jobs need to have something, so they start a business. This could mean they could be driving for Uber or delivering for Grubhub or one of these kinds of things. Many of these are the kind of ventures that you don't expect will eventually hire, but some of them, I'm sure, are going to eventually hire people to work, whether that's in a retail environment or that they're designing an app or that's an engineering firm or a new architecture firm, whatever. There are businesses starting, and we have applications for business entities are up. These are S corps and C corps and business licenses for sole proprietors and these kinds of things. And so we're definitely seeing a spike in that activity. Maybe that leads to big things down the road, unknown. And I think, Scott, you have a story about one of these, don't you? You want to talk about pastrami in San Francisco?
Yeah, we have a good friend of ours and a business partner who is opening up a pastrami store. Signed a lease, five-year full lease, and got a little bit of some credits. It's a little bit of favorable treatment because commercial is a little off than normal. It's a pastrami shop in the heart of the Castro. I don't think the location can be any better. And within the next 30, 60 days, the doors are going to open. So there's that definitely going on out there. But like the old saying, like when one door opens, one door closes, another one opens. That's going to happen here, for sure.
And didn't you mention something about? Do you want to talk about the Cliff House real quick?
Yeah, we were just talking earlier. A big announcement came in the news locally here. The Cliff House, which I didn't realize had been around for over 150 years, but apparently it has. Beautiful restaurant. It's like 3 different restaurants overlooking Ocean Beach. And after 150 something years, they are closing at the end of December. So it just speaks to the impact that this has had on certain very specific sectors of the market, like restaurants.
And since we talked about it earlier, what happens when a restaurant that's 150 years old that has, they have the ovens and they have the tables and they have the silverware, they got the plates, everything's there. What happens with that, after they go under? Usually.
what, with any decline or, another expansion begins. And so what you're going to have here is you're going to have another restaurant open up and have an incredible location. That's still yet to be determined, but there was a lot of pent up demand to do things before COVID happened, and people that wanted to start a restaurant have a really opportune time to get in that business now. Cost structures are cheaper. Everything's cheaper for them. Everything.
Yeah, I know that just rents in San Francisco are off like 35%. John, you have something?
Well, usually what happens is, depending on the structure of the business, all that stuff could be auctioned off, because some other restaurateur opening a restaurant somewhere else, they can get that equipment for cheap. And speaking of restaurant closures, a very famous restaurant in New York City, 21 Club, one of the original speakeasies from back in the day with secret rooms and secret doors during Prohibition, they're shuttering.
Wow, I didn't know that.
Wow, that's yeah, I know that in our home turf here, there's a lot of restaurants that are closing as well, and we're very close. Eli worked really hard Friday, Saturday, and Sunday at Saul's, and now they've gone to pure takeout. And I know did Lalim's close?
Yes, Lalim's closed about 6 months ago.
Yeah. So there's a lot of this happening, and we've talked about it here before, and John mentioned it as well. The material goods that exist in a restaurant are still useful to another restaurant, and usually the first thing that happens is, assuming that the landlord wants another restaurant there, and that's a question about Seacliff, because I think we talked about, we don't know exactly who the owner is, but we think it's maybe municipally owned and it was leased to a restaurateur. And maybe the municipality wants to recapture that for another reason. Maybe they want to actually put another restaurant in there. We don't know. But if they decide not to put another restaurant in there, then as John said, the ovens and all that stuff gets sold to somebody who wants to start a restaurant someplace else. And that's how a lot of the stuff gets recycled, reused. So the last thing I wanted to touch on that I think maybe we're early in this conversation. It's not that I haven't heard of it yet, but we are going to hear for the next 4 years, the reason that we can't do a lot of good things for people who are in need is because of the enormous budget deficit that we've created this year. And there's going to be lots of conversations about, modern monetary theory. There's going to be lots of conversations about what are the limits that we can put in place. I think what's going to end up happening is, and we'll know a lot more after the vote in January in Georgia, but it's very, very likely that we have to please a lot of different people in order to get any kind of budgeting or any kind of financial fiscal stimulus thing passed. Right now, we got to have McConnell and Trump and both parties in the House and the Senate. So it's going to be very difficult. We may get something if we continue to see weakening numbers in employment. That'll increase the probability that they'll do something. If we don't see, like if the next couple of weeks we see positive numbers in unemployment, then it's less likely we're going to see something come from the politicians in order for provide some kind of fiscal support. But almost for certain, when Biden takes over, we will see some kind of fiscal support. And I kind of wish David was here, because he would probably have some kind of comment about that as well. But does anyone else here have any thoughts about U.S. federal current deficit, and then longer term, just the debt that we have to figure out?
The only thing worth mentioning is it sounds like it's a $1.4 trillion omnibus deal they're talking about, and they're getting closer, which looks like we'll probably get that in the first quarter. So we can't ignore that and that positive stimulus that's going to be. And before we're done with this call, we definitely should spend a couple minutes talking about the IPO market, because it's pretty robust. I want to just make sure we spend a couple minutes on that as well.
Yeah, why don't you take that?
Sure. Well, an interesting soundbite here, which is sort of hard to believe, but I guess it's the case. So the IPO market is so heated that the last time you saw something like this in the IPO market was actually 1999, where you had, I think it was 100 and, what did they say here? 117 IPOs went up 100% or more in 1999. We haven't seen that kind of ferocious appetite for new deals until now. We've got 19, which is the second most since 20 years ago. So when you've got things like Airbnb and DoorDash and rocket companies and Snowflake and all the others doing what they've done, I think it just speaks to where rates are. And so there's no real good place to put money or proceeds or capital right now. And how excited people are about the growth and the future of a lot of these companies. But it does look and appear to be a little bit much from where our valuations sit and what looks reasonable to the prudent investor, the four guys on this call. But it's exciting to watch. And we have some clients where rebalancing, making sure they don't have too much exposure. And so it's an exciting time, but it's also time to inject a little ice water in your veins and really chill out and what's real here, what's reasonable and what makes sense, for long-term investors versus the euphoria that's popping around, I think, in the IPO market.
Yeah, and I don't know in the numbers you're talking about, the 19, I don't know if they've included the SPAC
We did.
systems.
Yeah.
So it's really interesting if you read about the implosion that became the Great Depression, the implosion that followed the Nifty 50, and then the implosion that came at the .com. They all have this kind of a funky investment structure that exists, that comes about, that allows people to put a whole bunch of capital and overbid for things that are, ways to bring them public, ways to, have dark pools that invest, and so that the investors who are putting their money to work don't necessarily know how and what those things, the real values are. They're not. Right now, if you buy a share of a company, even one that's recently public, the price you pay, their earnings, you can figure out a PE ratio. With these SPACs, you don't necessarily even know. You're giving a manager some money and they get to go buy whatever they want. There's a lot of stuff that happens behind the scenes that may or may not be a positive. So here we go, 10 biggest IPOs of 2020. Very interesting. We have a bunch of clients in Airbnb, and it's fun to watch that. It's fun to watch people who've worked in a place for 5 or 6 years see the results of that. That's it's really great for them. They've worked hard for a long time, and to have an outcome like that, it's really great. So I think it's really important to think about this, and it kind of brings up this other issue of, and we don't want to spend too much time on this, of the valuations we see and why we're seeing valuations as high as they are. One of the things you talked about is the low rate environment. And so when you are discounting the value of future returns, you have to discount the value of future returns based on some number. And the lower that number is, the more you can pay for those earnings for it to make sense. So if your discount rate is 0, then technically earnings are infinitely valuable. So we don't have a discount rate of 0, but we have a very low discount rate, which is why you see a lot of valuations as high as they are. We always just want to remind everybody that and this is kind of what I think Scott was alluding to earlier, the high valuations we see are still very siloed. So very large, very high-techy names are worth a lot, per unit of earnings. Whereas smaller companies that manufacture bolts or fixed bridges are not worth hardly as much. And so there are still opportunities in the market, both domestically in smaller companies and internationally, emerging markets and Europe and Japan. There is a lot of value out there. And one of the things we've seen that's benefited our portfolio specifically in the last month, and who knows if this is a turn that lasts a long time or if this is just a short-term blip, but international, small, and value has actually turned a corner that we haven't seen for a long time. And I think maybe this IPO, the headlines around the IPOs may pull some of that attention away from that, but it's really important to realize that the way we invest in smaller companies, value-oriented companies, and with global diversification, we largely, we're still subject to Apple. We're still subject to these, but a much lower percentage than most investors that are just buying the S&P 500 right now, or that are picking their own stocks and picking 5 companies, because they're always going to pick the 5 that that your cat's killing me, Scott. The 5 that are the most highly valued because they get the most attention in the media. But I think that's that. I think the thing to be wary of going forward is the conversation about deficits and how bad they are. Just expect it. It's going to be there. It's going to be a big argument between politicians. Look for our letter in January. And thanks for tuning in. Those of you who could make it. Are there any questions, or Scott and Paul or John, have you guys heard any questions that you want to ask or talk about here?
There's no chance of anything stimulus-wise happening while Trump is still in office? Is that true?
No, there's a chance. I'm not. Yeah, it's a small chance, but it's possible. I'm not. We're not going to make any long-term decisions based on something that may or may not happen in the next 4 weeks, but there's a chance. I hope that he does something. I don't know.
Yeah, I mean, and also I was talking about this over the weekend. Where are you coming down on Biden and his administration regarding taxes, capital gains, all that kind of stuff?
Well, I think the reality is much depends on Georgia. And we don't know that outcome of that. We won't know the outcome of that for a while. But even if it seems a very, very, very low probability event that both Georgia seats go to the Democrats. But even if that were to happen, there's still enough disagreement within the Democrats, within the Democratic Party, that it's unlikely that Biden will be able to do all the things he said he wants to do. The will is not there. And that's if they had both of those seats. So that by itself is highly unlikely. So I think we're going to see a lot more gridlock. I think we're going to see more gridlock. Even if Democrats win both of those seats, we're going to see gridlock because we don't have agreement within the Democratic Party about the right next steps, or the right amount of tax increases, or which kind of tax increases, or on whom those tax increases should be applied. So because we don't see that agreement, we're not going to see a lot. It's going to be negotiated, and it's going to be hard fought negotiations. I have some hope, not a lot of hope. I have some hope that there are 3 or 4 Republicans that may actually that may be more likely to get the votes for a centrist kind of position than you will get 3 or 4 very progressive Democrats. So it kind of leans us towards the center a little bit, which is probably, from where we sit in Berkeley, it's not what we'd like to see, but at the same time, it's something. And if we can get something done, it's better than nothing. I think we'll see tax rates go up on us. And I think that's reasonable, personally.
And Jonathan, to your point about the growth value and also international, I was looking at some numbers in the market recap, and it's been the complete opposite until this last quarter, where you see values outperform growth by about a little bit more than double. Europe's around 13% compared to, I guess, what Dow Jones is 9%, and emerging markets is up 16%. So yeah, you're seeing a shift to international and value, certainly, which is in the last 3 years, you've seen complete opposite in a big way. So we'll see what happens.
Thanks for the numbers. That's great. Scott, you wanted to add?
I just think a real good takeaway, because I am hearing this from people that I talk to, including somebody this weekend at brunch, how this is, it's just technology. And I just think that that's really bad information. When you have the likes of Nike and Disney and Starbucks and FedEx, like these are completely untechnology related names in different spaces, hitting all-time new highs in the last week. There's a case that it's not just technology that's very clear out there. And I think the idea of spiking cases and the headlines will take investors' eye off the ball every time. And please don't focus on them, because they're going to make you doubt your plan. You can create emotions. They're going to encourage bad behavior, and it's just a bad recipe for good outcomes. So it's not just technology. Don't focus on these headlines. And cases have been spiking for a long time. And the good news is, unlike this vaccine we were hearing about months and months and months back, 50, 60% efficacy, Now they're talking 95% efficacy. So this is not going to be kind of, we have to live with COVID the rest of our lives. We're going to eradicate this thing like polio. I think there's a real positive to that as well. I think the markets are discounting that, looking out 12 to 18 months. And I think that's why we are where we are. But I'm not forecasting. This is just a hunch.
No, we have a plan that takes into account the long term, right? And long term, even if the vaccine, even if there's a new, strain, even if if something new comes out. And over the weekend, I watched COVID-23, which I don't know if that was a Netflix show or what it was, but it's a horrifying concept where we're all locked down for the next 4 years. That's not a base case. That's not something I'm thinking about, but is it a possibility? Sure. But we're not thinking about that. We're thinking about long-term. Even in that case, companies will have to provide food. People will be buying shoes. There's going to be people want solar panels and jeans and cars. All these things happen, not just technology.
Is it possible, John, to give us a Sherry real estate update?
Well, at least from the corridor from Richmond to Oakland, usually this time of year it would be quiet. The real estate market tends to quiet down from Thanksgiving through January, and then the season kicks off in February. Well, it hasn't quieted down at all. It's very strong. There are a lot of people that want to leave the city of San Francisco. They want to come over here. There's great deals on condominiums. People want to be out of condominiums and into a single family home. They want a yard. And a lot of this really is COVID related. They don't want to share elevators or common hallways, whatnot, with others anymore. So things are strong. There's a lot of buyers, and inventory actually isn't too bad either.
Well, yeah, it's interesting to talk about how strong the real estate market has been. And this is something that's, I don't know if you guys saw these numbers, but in the US, the level of individual wealth is higher now than it has ever been. And it's hard to grasp that and know that in a pandemic, there's 20 million people that are out of work and 40 million people that are underemployed. So real estate has just shot through the roof during this pandemic, all over. Like my wife and I, and myself specifically, I search through real estate constantly. I look at real estate in Rapid City, South Dakota, where I'm from. I look at real estate here. I look at real estate in Tahoe. I look at real estate in Colorado. I'm always looking at real estate. I love the topic, and everything is contingent, pending deals on so many different places all over the map. It's amazing. And at the same time, equities are at all-time highs. And those two things together, those people that are haves, that can afford a house, that have investments, we've done incredibly well. And so today this is the last one of these we're going to do for some time. We don't have one scheduled for January. We don't think we're going to do our forecasts in January, and we're going to get back onto our semi-annual schedule here. But in this next couple of weeks, it's the standard time for us to really be thankful, show gratitude, help people out in need. A lot of the ways that we did this historically, they're not even there anymore. We can't even support with the turkey basket drive and those kinds of things that we've done in the past. Those things they didn't happen this year. So whatever you can do within your communities, do those things. If you're somebody that owns equities and owns your own home, you're doing far better than 90% of the population. So do something good for folks that are in your community. Give back, and happy holidays, everybody. Thanks for a fantastic 2020. It's a rough 2020, but thanks for being great clients, and thanks for sticking with us through this. And we're very appreciative of everything you bring to our community. Thank you.
Thank you.